Welcome back. You're with us on Big C on CNBC TV18 Prime. Joining us now on the show is Philip Newman. He is Managing Director at Metal Focus. Philip, hi, thank you so much for joining in. I want to start asking about why is gold not rising despite a war that's raging? A 19th day is where we are into it. And usually if you go by textbook, gold is a safe haven commodity. But this time around, that clearly doesn't seem to be happening.
Well, first of all, thank you for having me back on. It's a pleasure to be here. I think we have to put into context of how gold has performed in recent months. As you remember, it was only back in October when it broke through $4,000. Since then, it's been on an incredible run. That obviously came to an end to some extent late Jan when we had that correction. And I think since then, we've had a bounce of profit taking. So I think that's been part of it. The run-up has been, I think, so marked, so extreme, that I think we were bound to have a period of consolidation. I think perhaps one of the reasons why gold isn't reacting to the war is that, in terms of the movement in oil prices, what this means for inflation, and by extension, rate cuts. We've certainly seen many governments, or many central banks rather, that have postponed rate cuts or keeping rates on hold. And I think the expectation is that we could be in for potentially a more hawkish Fed this year. And I think that is weighing on the markets. I think the other point, of course, Manisha, is, we've had weakness at times in the equity markets. And I think, gold being such a liquid asset, that has been sold off to meet some of those margin calls. So I think there's a few reasons. And I think also it can become a little self-fulfilling. The fact that gold isn't reacting has disappointed some investors. So I think they're waiting for some direction. At this level, it sort of feels like it's treading water, even though the price is still exceptionally high. $5,000, I think, is a pretty decent price all told. So I think there's a few reasons. I think the last one of those, the fact that investors are waiting for guidance on whether, if prices were to correct, they could consider bargain hunting. If prices were to move higher, they could buy into the rally. But I think right now it feels a little bit like a wait and see.
Philip, that point is well taken. But at Metal Focus, is the year-end target for gold still the same as $6,000 an ounce, is what I remember you told me last time? Are you holding on to those levels?
Absolutely, yes. For the time being, in spite of what's going on at the moment, I think there's a few factors out there. I mean, obviously, in terms of the war, we hope it doesn't spread further, but that certainly is one of the risks. And the Fed that I've mentioned, we were expecting rate cuts. It'll be interesting to see at which point they resume this year. But I think one of the uncertainties, I touched on the risk to inflation. Does that mean that the Fed becomes a little more hawkish? Well, that certainly isn't what the US president is looking for. And does that, and how he reacts to that sort of dynamic playing out, does that again call into question the independence of the Fed? And I think if that's the case, that could be quite damaging for the US dollar. We still have concerns, of course, about US debt levels, the ability of the US government to service those debts as well. So I think there are still a few factors out there. And of course, again, coming back to Trump, the way he has treated tariffs at the start of his second term last year, sort of weaponizing that instrument, that doesn't seem to be off the table. So I think there's still plenty of reasons to keep investors interested and to encourage them back into the market. And yes, we are, for the time being, still looking for 6,000 before the end of this year.
What we do also understand is that because of the West Asia conflict, the GCC countries basically have not seen any demand for 2 weeks now, whether it's for investment or jewelry. And we also do understand that the gold prices there are trading at around $20 to $40 of a discount. How are you looking at that situation?
Absolutely. We're certainly hearing, you touched on jewelry, and I would certainly agree with that, Manisha. but in terms of the retail investment, the small bar, that I think is also exceptionally weak and across a whole number of countries, let alone the I guess the apparent lockdowns, the fact that their flights are only I think now gradually resuming, but of course to a very limited extent. So the ability to move product around the region is a huge headwind. But added to that is a point I just made about the fact the way the gold price is behaving at the moment, that sort of directionless dynamic that's playing out is also discouraging investors from coming into the market. So I think there's a few factors why this is playing out. And as you may know, people you've spoken to, the fact that Dubai is in, I think, a pretty steep discount at the moment.
Philip, also when you look at the overall markets, the demand also seems to be on the weaker side because gold, for one, is stuck in a narrow range. It's not doing so much. If anything, it's just broken $5,000 an ounce in the day today.
I think overall, from a retail standpoint at the moment, yes. But we've got to take into account that, in terms of the whole quarter, that, the start of it, as I touched on earlier, Manisha, was exceptionally strong. It was exceptionally strong in Q4 coming into January. January, I think, was an incredibly good month. We started to see things tail off about the middle of February with, I think, some markets, I think the word quiet, I think it's a challenging word to use. I think perhaps more accurate, there's like a normalization of buying in some jurisdictions. It just felt quiet in the context of what we'd seen over the previous, 4 months, 4 to 5 months. But yes, I think that's certainly, I think jewelry has, I think, taken a bigger hit compared to the bar market. As you may remember, from focusing on China, that last year was the first time that retail demand exceeded jewelry consumption. And then we came into this year, of course, with the introduction of VAT on jewelry, that I think took more of a hit in the run up to Chinese New Year at a time when bar demand was also relatively strong. So I think, come back to your question, for the first quarter overall, I think it will be probably not a bad quarter given the strength, especially in the first sort of 6 weeks or so.
Point taken. Philip, also coming on the India context then, and even as last year was a record buying in the global markets as well, but it was more about the investment and not so much about jewelry. In India's context, where we are looking at Dubai as a major hub, not so much of a buying. And in my conversations with most of the industry participants, they tell me that this quarter isn't going to be very strong.
And I think, what we said earlier in terms of not just the Middle East that you spoke about and how important that is for the Indian Sikhs, for example. The likes of the US is also struggling to some extent. If you think about major retailers there, that coming out of Christmas, normally the first quarter is a time when they're looking to place orders, thinking about, not really Valentine's Day, but Mother's Day, even just leading up to the following busy period. And I think some of those, what we call open to buys, their ability to buy product will be challenging given where the gold price has been. Again, even if we put aside the record highs we've seen, as I mentioned earlier, $4,000 in October, having to buy jewelry at around $5,000, that will weigh on many suppliers to the US. India will certainly be an important part of that, but as well as the Italians and the Thais, for example, as well.
Would you say in the time that we are in right now, gold perhaps is a better bet than silver? Silver has been volatile, hasn't been holding so well, but gold clearly seems to be working with a strong base.
Well, that's a very good question. I think, the fact that, as silver, quote unquote, is only $80 an ounce. It's an incredibly strong price, isn't it? But I think, when we look at the run up, it's had the correction as well in late January, echoing what we saw in gold. I think, again, from an investor standpoint, I think there's an element of waiting and seeing. So that's certainly something that I think will be affecting the market. Um, Again, from a retail investor standpoint, really echoing what we saw in gold. So really incredible fireworks the back end of last year into January, but things have again in quite a few jurisdictions, they feel like they've also normalized as well. And I think investors just waiting to see whether these prices do sort of break out of this range on one side or the other.
And what would you say are your targets now for silver? Because we've seen $100 an ounce plus, but we're not unable to hold at 80 right now. How are you looking at this year ending for this?
Well, I think, if we're looking for gold to get to 6,000, then we do think that silver before the end of the year will break through $100 as well. And I think, if you do break out to the upside, then I think you would see Indian investors, investors in the US, Australia, Germany, these being sort of the key retail markets. I think they will come into the market in a big way. Of course, the key driver will be institutional or hedge fund activity. Again, for all the reasons we spoke about, the uncertainty around the Trump administration, principally, I think that again would encourage investors back into the market. Hence, why we do believe that silver could, again break through $100 before the end of the year. I think the other thing, Manisha, just quickly on the industrial side, I think there will be some elements where there will be considerable pushback on using silver if you're going to price that high, or even frankly $80. But that is not going to be universal. There are plenty of areas where we won't, in our view, MLS Focus, we won't see thrifting, for example, when it's used from a safety point of view, such as in an airbag or braking systems in your car. So it'll be quite a mixed bag from that point of view. But overall, we still think industrial demand will perform pretty well this year.
All right, so 6,000 ounce for gold and $100 an ounce for silver could be coming back by the end of this year. Philip Newman, as always, thank you so much for joining in for that conversation. But with that, that's all the time that we have on this episode of Big C. Thank you for watching.